long iron condor, by far my favorite strategy to use to be able to make money both ways. So firstly, remember, before you ever enter any options trade, please make sure you know how to close it. I'll pin a video in the comment section below where I show you guys how to close out of any options trade. Now let's first start by talking about our goal here today. So our goal with the long iron condor is going to be to profit from bullish or bearish behavior in the underlying stock, and all of this with limited risk. So again, that just means that before you even enter the trade, you know exactly what's the most you could potentially lose, what's the most you can potentially make. And so the ideal situation here is you believe a stock will make a decent move, you're just not sure which way it's going to move. So think of things like earnings, FDA approvals, product launches, news events like this that cause a stock to move quite a bit, but you're not really sure which way it's going to move. So you'd like to be able to make money both ways here. So what I'm going to do here for today's video is I'm going to use ticker symbol CMG to take you guys through the long iron condor. This is going to be Chipotle. Again, everything I'm showing you here, guys, is just an example so that you guys understand how to set up this strategy, how it works. So don't copy this exact same trade. It's just an example here. But let's say we wanted to enter a long iron condor using Chipotle. Let's say we see a potential move coming for Chipotle. We're just not sure which way it's going to move. So before we go into the options, again, two very important things we always need to check. First thing is commission fees. We're going to be opening and closing multiple contracts here. If you're on a broker with high commission fees, that might eat away at some of your profit. Now, Robinhood doesn't have any commission fees, so we don't have to worry about it on here. The second thing we need to check is early assignment risk. Why? Because we're going to be selling options. Anytime we sell an option, there is risk of assignment. We want to avoid being early assigned due to the ex-dividend of a stock. So always check, does the stock have a dividend? If it does, when is the ex-dividend date? You want to avoid selling options on the week of the ex-dividend. If you do sell options that week, you want to close out 2 days before. So remember, we can always go over to NASDAQ.com and just search up here for whatever stock we want to use. Again, for today's example, we're using Chipotle. So we can come in here, click on Chipotle. Then on the left, we can click on dividend history. And again, this will show us, does the stock have a dividend? If it does, when is the ex-dividend date? Now let's take a look here. When it comes to Chipotle, it does not have a dividend, so you don't have to worry about that. So now that we've taken a look at those two things, we can actually get into the options here and talk about how you set up a long iron condor and how it's gonna work. So let's take a look here. So first things first, guys, you do not need 100 shares of the stock or own 100 shares of the stock to use this strategy here. Now, as the name suggests, right, long iron condor, long meaning we're going to enter for a debit. So you're going to pay to get into this trade, as opposed to the short iron condor, which is probably the iron condor you guys are most familiar with, where you basically enter for a credit, you get paid to enter, and then you want the stock to trade sideways. Here, we're going to enter for a debit, and again, we're going to want the stock to move in either direction here. So first thing you want to do is choose a proper expiration date. The idea here is that the stock will make a decent move one way or another by your expiration. So I'm just going to leave mine as it is. Let's say I think something's going to happen today or tomorrow. That might cause CMG to move quite a bit in either direction. So now we can actually go into the options here and select the options that we need. So I'm going to talk about how you would select the proper options here. So the first thing you want to do is we're first going to start actually with calls. So we're actually going to be using both calls and puts here. So we'll start with calls. So we'll just leave it on call. The first thing you want to do here is determine if the stock were to go up in price. What price will it go above, right? What price do you think it's going to go above if it ends up going up in price? So let's say that if CMG ends up going up in price, I think it's going to go above $1,700. So then what I would do is I would start there, and I would start by selling a call at that strike, or the closest strike to the price you came up with, right? So if we go up here, we'll see an option that has that strike. So right here. So I can switch over to sell, and I would sell this call right here. Okay, so again, you first start by determining what price it's going to go above. If it ends up going up, sell a call at that strike. Now the next thing we want to do, now we want to switch over to puts here. Now we're actually going to sell a put. So now you want to determine, okay, if the stock actually ends up going down, what price will it go below? So let's say that if CMG ends up going down in price, I think it's actually going to go below $1,600. So again, I'm going to come in here and I'm going to look for the option with the $1,600 strike. So this one right here. So now what you want to do here is you want to sell a put at that strike. Right, so very simple so far. If it goes up, what price do you think it's going to go above? Sell a call there. If it ends up going down, what price do you think it's going to go below? You end up selling a put there. Now we need to buy two options here. We need to buy a call and we need to buy a put. So let's actually first start by buying our put here. So now we're going to buy a put. We want to buy a put with a higher strike than the strike of the put that we just sold, but with a lower strike than the strike of the call that we sold. So I'm just going to go ahead and buy the put at the 16.25 strike. So this one right here. Okay, so I'm buying a put, higher strike than the put I sold, lower strike than the call I sold. Now the last thing we need to do here is switch over to call, because we also want to buy a call here. So now I want to buy a call with a strike less than the strike of the call I sold, strike higher than both of the puts here, and the distance between the calls needs to be the same as the distance between the puts. So if you take a look at our puts, the distance between these is $25 when it comes to the strikes. So now I need to buy a call that's also $25 away from the strike of the call I sold. This means I need to buy the call at the 16.75 strike. So right here. Right, and so now we're going to get our long iron condor, right? So we have our call that we're selling, then below that we have a call that we're buying, below that we have a put that we're buying, and then finally below that we have a put that we're selling. The puts, the distance between the puts is the same as the distance between the calls. And so you should get something that ends up looking like this right here, okay? And as you can already see, right, we're going to be able to make money if the stock drops, or if the stock ends up making a decent move to the upside. So now, again, before you even enter any trade, I recommend going over to option strat to visually take a look at what your trade is going to look like, what your profit loss will be depending on the date, depending on the share price, depending on changes in implied volatility, and all of those things. So let's go over to option strat now. Let's quickly take a look at what this would look like. So let's go to build, and we'll just start at long call here. And so let's first choose the stock we're using. So CMG for Chipotle. And we chose our expiration. We just left it as August 26. And so again, we first said, okay, if it ends up going up in price, what price do we think it's going to go above? We said 1700. So we said, okay, start by selling a call at that strike. Then we said, okay, well, if the stock instead drops in price, what price do we think it's going to go below? So now we said, okay, well, let's go ahead and sell a put at that strike. And we had said 1600, right? And then we said, okay, now we want to buy a put. We want to buy a put with a higher strike than the strike of the put we're selling, but below the call that we're selling. So I said, let's just do the 1625. And then finally I said, okay, now we also want to buy a call with a higher strike than both of the puts, lower strike than the call that we're selling. And then the distance between the calls needs to also be the same as the distance between the puts. So the distance between the puts is $25. That means I have to buy the call at the 16.75 strike so that these calls now are also $25 apart. So this is basically what it ends up looking like. So let's take a look at what this looks like here. Let me just zoom out a little bit here. So let's go something like this. So again, this is a long iron condor. Long meaning you're going to pay to enter this trade. So you're entering for a debit. For this particular example, $670. Right? So Chipotle, has a pretty high share price. So the options are also going to be relatively expensive. And also how you construct this will also determine how expensive it is. So this is kind of expensive. But you also need to realize that Chipotle here is also a very expensive stock. Your max profit is pretty high, and the stock doesn't even have to move that much for you to make money here. But anyways, you have your max loss 670. That's whatever you paid to enter. That's always going to be your max loss. Max profit is 1830. So again, before you even enter this trade, you know exactly what's the most you can lose, what's the most you can make, and then we have our break evens. So again, we can make money both ways here, and you can see that already, right? If the stock ends up shooting up, we make money. If the stock ends up tanking, we also make money here. Now let's talk about where your max profit is going to occur here. So let me just change this a little bit here. So your max profit is going to happen two different areas here. So if at expiration, the share price is above the strike of the call you sold, so if it's at $1,700 or above, that's where we would make our max profit of $1,830, as you can see here, right? If it's a little bit less, like $1,694, you would only make partial profit. Now you can also make max profit on the downside. So on the downside, if at expiration, the share price of the stock is below the strike of the put you sold, so if it's at $1,600 or below, you'll also make your max profit of $1,830, as you can see here, right? And then it doesn't matter how much lower it goes, you would still only make $1,830, which is your max profit. So you can make your max profit two different areas here. Now, as you can see, right, you do not want the stock to trade sideways, because that's where you're going to end up losing all of your money. In fact, if at expiration, the price of the stock is between the put that you're buying and the call that you're buying, if it's between 1625 and 1675, like you see here, that's where you're going to lose your max loss, which here is $670. So you want the stock to make a move up, or you want the stock to make a move down, right? And depending on your strikes, the stock you use, it could vary how much it has to move. But for example, here, if it only moves 3% tomorrow, you could walk out with $1,800, over $1,800. But of course, this is just an example here to show you guys how this would work. Now, of course, you can also close out of this at any point in time. So let's say it's today, and all of a sudden Chipotle pops up 3%, and now you're up $900. You can close out at that point, right? You don't have to let it expire. You don't have to wait until expiration. You can close out at any point in time. And of course, the last thing we always need to check here, guys, is changes in implied volatility. So we have this slider down here on the bottom right. So right now, IV is around 39%. So if IV starts to drop, here's what you could expect to happen and how this would look. Something like this. You start to see more red, it looks like. Now, if IV instead, if we reset this, if IV instead started to go up, here's kind of what you would see. And as you can see, you actually start to see more green here. So for this particular example, we would want implied volatility to increase, because now we see a lot more green, versus if IV starts to drop, now we see a lot more red. So always very important to check that so there's no unexpected surprises when you enter the trade. So anyways, that is the long iron condor. If you guys have any questions about anything I just talked about, feel free to leave them in the comment section below. Check out the Discord, link to it in the description below. Hope you enjoyed the video. Let me know what you guys think, and I will see you guys next time.